Yo, what's good, guys? Hope you guys are all staying safe out there. Hope you guys are all healthy. And today, I know a lot of you guys have been requesting that I do more fundamental videos talking about, interest rates and data and just really that has everything that has to do with fundamentals. So here is basically my first video I've done on this topic. So I'm really excited to share this with you guys. I think, at least I hope, it will help out a lot of you. And yeah, these things called interest rates affect markets quite a bit. Actually, they play a big role in the market in general, but especially currencies. A lot of how they move is determined by interest rates. So this is quite important to understand. Let's jump right into it. Starting off, what are interest rates? All right, those captions were annoying me, so I'm just going to get rid of them. So, what are interest rates? An interest rate is the rate at which a nation's central bank, so most developed nations have a central bank, and they control all the money in the country. So, they determine what rate at which to loan money to domestic banks, like Chase, credit unions, all banks. They determine what interest rate that they will loan them, and then it's usually more short term, as I mentioned here, and this is how the central bank manages the economy, inflation, and by cutting rates, they will help boost economic activity, right? Because people can borrow money cheaper for houses or businesses or cars, whatever it is. People will borrow more money and thus get the economy back on track. And on the flip side of that, central banks will raise interest rates if inflation is getting too crazy, the economy is growing too fast, which doesn't sound like a bad thing, but if inflation gets out of control, that can be. So they raise rates to sort of help curb the inflation, so people will stop borrowing as much, and get that inflation back in around 2%, which is what most countries shoot for, is around a 2% inflation. So, why are interest rates important for trading currencies? So, currencies, as we know, are influenced by how each country's economic condition is perceived. So, if one country is not doing good, their currency usually isn't performing well either. And if a central bank is cutting their rates, that is not a good sign, since that means that their economy is contracting and they're trying to boost economic activity to get it back up to what whatever their goal is. And this has a negative impact on the currency. If a central bank is cutting rates, the currency will go down. On the other hand, as I mentioned, raising rates means that the country is growing and they need to rein in the inflation. This is a good sign, and it has a positive impact on a currency. If they're raising rates, that means a currency will most likely go up. And on top of that, statements from the central bank, usually released at the time of the interest rate decision or sometimes later on, can also impact the currency if they give out hints about future plans to cut or future plans to raise rates, or future plans to not do anything and just keep the rates they're at currently. That can also have an impact on a currency, because if they suggest they're going to keep on easing into the coming months, then the currency will most likely stay weak for a certain amount of time. So that can also give a good clue. Moving on. So what influences a central bank to cut rates? How do they track inflation? How do they determine when they're going to cut rates, or if they're going to raise rates? I know here I put cut rates just because right now we're in a time where cutting rates is really the only thing that they can do. No one's looking at raising rates, so that's why I put that. But this also will influence them raising rates. So data is important. Data is very important. This is how they determine how the country is performing economically. So they look at unemployment, they look at CPI, PMI, and CPI is a good indicator of inflation. They look at GDP and they look at sentiment, how businesses and consumers are perceiving the economy around them. So all of this will impact it. We've seen, for example, the RBA, the central bank for Australia, will look at unemployment very heavily, and if that is increasing, then they will oftentimes cut rates because unemployment is increasing. For example, they look at data. Next, geopolitical events. So, like tensions in the Middle East, as we saw at the beginning of this year with Iran, that could impact central banks to cut. And of course, it depends on which central bank. Another thing like fires, like natural disasters, anything bad. It doesn't necessarily have to be economical, such as this coronavirus, right? That has caused many banks to cut rates. So it doesn't all have to do with data. Also, like trade wars, as we know, U.S.-China trade war over the last 3 years has caused a lot of rate cuts because it has impacted multiple economies. Europe, almost every economy has been impacted from that trade war, and thus led to them cutting rates. So all of these things tied in together will influence a central bank to make interest rate decisions. So those are the type of things to look out for. And a lot of times you can sort of predict if a central bank is looking to ease further, which, by the way, easing means cutting for the most part, and it could mean like quantitative easing. And then when people say monetary tightening, that means usually raising rates to tighten the economy and rein it in from inflation. So what can happen to the interest rate? What happens most of the time, if you look at throughout the last decade or two, the most common thing that happens is they hold rates. They keep rates what they are at. So, like I said, the base scenario, usually they'll keep rates unchanged and continue to monitor data and developments like with geopolitical events, trade wars, etc. They'll just continue to look at it and see if further action will be needed. That's the most common scenario. And oftentimes that has mixed results with the currency, nothing too crazy. But the other two options, which is to cut rates, which occurs when the economy starts heading towards a recession, growth starts to slow. We start to see data coming out worse, GDP will start getting revised lower, et cetera, and then they might look to cut rates. And as you see, that has a negative impact on a currency. And then on the flip side, they can raise rates, which means inflation is getting out of control, and this will have a positive impact on a currency, right? Pretty binary stuff, nothing too crazy. Moving on. So real quick, how often do interest rate decisions happen? Well, usually they meet 8 times a year to decide this. They have an interest rate decision 8 times a year, except for the Reserve Bank of Australia, aka the RBA, has 11 of these. So don't ask why, I'm not quite sure. But yeah, roughly once a month, let's just put that out, roughly once a month, there's interest rate decisions for a central bank, give or take. And then I just put the nicknames. So the Federal Reserve, people call it the Fed. The European Central Bank is known as ECB. RBA, Reserve Bank of Australia. Reserve Bank of New Zealand, the RBNZ. Bank of Japan is BOJ. Bank of England is BOE. So if you see this, if you see BOJ or you see RBA, that is what people are referring to. So there's 4 general ways that you can trade interest rate decisions. There's not one way to go about it. Number 1, which is I think the most common way people think to trade this, is to get in 5 minutes before or an hour before the decision is announced. However, I only recommend this if a cut or a hike is expected. Then you have a higher chance of being right in the direction of the move. However, a few things to note with this scenario. The risk of your stop not getting triggered because of the high volatility of the event is possible. So make sure your broker is good. Make sure you're not trading too heavy on size, because sometimes stops don't get hit and you'll be down negative 200 pips, 300 pips, something like that in a matter of seconds. So that's one thing you have to be careful with on this option. However, it can give you a great risk reward ratio, right? If it stops 50 pips and you have a potential gain of 300 pips, that's a great risk reward. So there's pros and cons to this. Yeah. And don't expect to be right every time, because, surprises do happen and markets react, in weird ways sometimes. Next option, you can wait for a pullback once there's a spike on the decision on a lower time frame and then ride the trend up. This option I don't recommend unless there was already a strong trend in the direction of the spike. So if the last month it's been heading up and then it spikes higher, then this option might be decent to wait for a little pullback and then ride the trend up. So that's an option. This would have worked well for the Bank of England decision like a month or two ago, considering over the next day or two it headed another 200 pips after the initial move up. Next, this is what I usually do, which is to trade the decision a week or a month. It varies, before the actual decision, if there is a strong anticipation of a cut or a hike. So if people are expecting them to cut, let's say people are expecting the RBA to cut rates in a month or two, well, the market is going to try to price that in ahead of time. So most likely the Australian dollar will become weak heading into that decision. So this is what I usually like to do to trade interest rate decisions. I will trade the weakness leading up to it. I'll trade the or strength, but as I've mentioned, cutting rates has been the norm. So that would mean a currency would be weak. So yeah, trading the market, pricing it in. This is what I recommend. It's less risky than these two, and you get to catch a lot of pips. It's a lot less crazy. You don't run the risk of your stop, not getting hit or whatever, because you're just trading sort of in a normal market environment, but the market is heading a certain direction because it is trying to price in this decision. Most likely, for the most part, it will price it in. If a cut is anticipated around 70%, then it will price it in around 200 pips. So, it moves a decent amount to price in these moves. Lastly, you can fade the decision. The initial spike, you can take it the opposite way. But there's an exception to this. And by the way, I will be showing you examples of this on the chart in just a second, because I get sort of abstract maybe here, just looking at the words. And I'm very much a visual learner, so I wanted to implement that into this video. So the only way that I recommend fading the interest rate decision is if there's a surprise cut or rate hike, or if they hold rates. Basically, if there's a surprise, if something was anticipated and it's a surprise, the market will usually spike a good 100, 200, 300 pips. Because it's been, like I mentioned in point 3 here, pricing in that move. So it will move in anticipation of it, and if that doesn't happen, then the market will try to reverse back to the point before they started pricing it in. So there will be a really large spike, if that makes sense. And so only if there's a surprise, and also if the counter currency, if whatever pair you're trading, the other one is strong in the opposite direction of the spike. So that might sound a little bit confusing, but I'll get into that right now. So example number 1. This happened, I believe, back in August or September of last year. This is the chart for the pound New Zealand dollar. So heading into the decision, we saw the pound was gaining some strength off the back of a huge downtrend, thanks to Brexit, of course. And then we saw the New Zealand dollar was somewhat neutral. So heading into it, they were expected to cut rates by 0.25%. So, it was sort of pricing it in. They were expected to cut rates by only 0.25%. And what happened? They ended up cutting by 0.50%. So that is perceived as even worse. So what happens? Well, the NZD, New Zealand dollar, if it gained strength, it would have headed down. However, since it was a surprise and it was worse than anticipated, we saw a huge spike up, roughly 300 pips, and as you can see, a very short amount of time. And this is when the decision was announced. So this is what I mean when I say you could have faded the move. Basically, there's two ways you could have traded this one. The first point, going back here, you could have got in beforehand in anticipation of them cutting, which would have netted you, a good gain. However, it's not necessarily because they cut it by this, but it's because they cut by 0.5% instead. So that was one way you could have traded it. The second way you could have traded it was in anticipation. Like I mentioned, the market's pricing in this cut, so the NZD is getting weaker, right? That was the second way you could trade it, which would have worked out nicely. And lastly is fading the move. You could have faded this move down. Why? One, it was a surprise. And when there is a surprise, the market spikes up quite a bit, and usually it will not sustain the move unless there was a strong trend in the direction already, which there was not. As you can see, this is not a very strong trend, and the pound was not super bullish. The New Zealand dollar was not super weak, so therefore this would be a nice move to fade. Not to mention, technically, this is a great place to short, but we're not getting into that right now. That's a whole different topic, but you could trade this 3 different ways, and you would have made money on all 3 ways. So this is just one example. You could have caught, like 300 pips here, 300 pips here, and then like 300 pips here. So, there's a lot of things you can do with interest rate decisions rather than just buying right before, right? Because I think that's what a lot of people miss, is there's many ways to trade these. And oftentimes you can even, like I said, combine them. Like you could trade this 3 different ways. Next example here is the pound Australian dollar. This actually occurred, I believe, at the end of January of this year, so like 2 months ago. We saw, the pound was somewhat neutral, somewhat neutral, if not a little bullish. But this was in a very strong uptrend because the Australian dollar was extremely weak. It was weak because, of course, the coronavirus has, back in January, it was still very much impacting markets. It didn't necessarily hit the U.S. market at that time, so maybe people didn't notice. If you're not a currency trader, if you're an average person living in the United States, you probably didn't notice much, but it actually was very much impacting currencies in January too. So we saw a nice strong uptrend. The Bank of England was expected to cut rates, which meant this would go down. However, we saw they actually held rates, which, as you see, caused a huge spike up. 400 pips you could have caught. So how could you have traded this one? Well, like I mentioned here, wait for a pullback on the lower time frame and then ride the trend. And the reason I didn't recommend it is because it's kind of risky unless there's a strong trend already in the direction of the move, which check, very strong trend. So this one would have been nice to get a little pullback on. When I say lower time frame, I mean like a few minutes after the decision, or like 15-30 minutes after the decision, and it pulls back a little. That's when you buy. I don't mean wait like a week or two. I'm talking, minutes to maybe an hour. Wait for a pullback, get in, and then ride the trend up. Another thing to mention, Another reason this had such a continuation and a huge bull run is because of the statement that they released after, and they had a very sort of hawkish tone. They were saying how they didn't want to cut rates anymore, and possibly even looking at raising rates, which obviously is very bullish for the pound. So that's an example of how, like I said, statements from the central bank can also impact the markets. Now, lastly, our third example here, again on the pound New Zealand dollar. I apologize that there's no USD or CAD pairs on here. I just don't trade them, so I'm not really familiar with the whole context around different moves. But I'm very familiar with these pairs since I trade them all the time. So this was actually a even more recent one than the Bank of England. This happened, I believe, in February, so like a month ago. We saw that the New Zealand central bank was expected to cut rates, right? As you see, in anticipation, you could have traded that. You could have traded the market pricing that in. Not to mention, you would have been helped by the fact the virus was making the New Zealand dollar weak. So that would have helped there as well. As you see, there was a nice strong trend. But there was a surprise. The Reserve Bank of New Zealand decided to hold rates. They didn't cut rates, which really shocked people. And as we see, when there's a surprise, huge spike down, 200 pips in a matter of, very short amount of time. This would have been one of those to fade. So you could have caught the pricing in, before the actual decision. And I actually faded this. If you go watch my recap on YouTube, my very first video, I took a long position here and rode this trend up. So another way you could trade it is to fade. Why would fading help here? Like I said, if there's a surprise move, which we did, we got a surprise move. They held rates when it was expected for them to cut. On top of that, there was a strong trend in the opposite direction. And the pound was, somewhat strong-ish, but also the New Zealand dollar was very weak. So, yes, we saw a huge spike for the New Zealand dollar, but the reason you can fade the move is because it's weak. So that will not be sustained and head lower. It will oftentimes head in the opposite direction, which is, as you see, what happened here. So multiple ways to trade this. Obviously, I don't necessarily recommend jumping in right before the decision because surprises happen. And, you would have, if you went long right here, you would have been eaten, would have been out 200 pips if your stop didn't get hit. If your stop was here and it got hit, then, you would have been fine, but you're just taking your chances. So I don't recommend doing that. But yeah, I hope this helped. I hope this sort of helps shed some light on different ways to trade interest rate decisions, what to look for. It's very important going into it, or at least even a month before a decision is announced, to know what is expected, to know, what the market is pricing in, and to know, what traders are going to be looking for. If, you could see that they held rates. Well, most people would wonder why this thing spiked down. I mean, they held rates. Like, that doesn't make any sense. It should be like neutral. But it had this reaction because the market was expecting it to cut rates, and it priced that in. As you can see, it fell to the level before it started pricing it in, right? Makes perfect sense. So I really hope this shed some light on different ways you can trade this. A big part of fundamental analysis is looking at interest rates. It's not all of it, but as you can see, it really impacts currencies quite a bit. So yeah, guys, I hope this helps shed some light on different ways to trade interest rates. Besides the usual, just, sort of guessing in a way right before and hoping to catch a big move. as you can see by these examples, it's really kind of fun trading interest rates because there's multiple ways you can trade them and many opportunities within just one interest rate decision. And as you saw, there is quite a bit throughout the year. So, quite a bit to keep track of. I hope this helped, guys. If you have any questions about interest rates, if something there was maybe a topic I missed or something you guys have to add, feel free to add it into the comment section, or just DM me on Instagram. Let me know. I'll probably see that a lot sooner than if you comment, but regardless, I would love for you guys to give this a like if you liked it. And if you gained some valuable knowledge, if this helped, if you feel like it can help your trading, feel free to share it with other traders, and feel free to subscribe because there will be a lot more content like this coming very soon. I appreciate all the views. I appreciate, just all the support you guys have given over the last few months. It's been very overwhelming. I very much appreciate it. And yeah, guys, I hope you have a great week ahead. Another volatile week, clearly, as we saw this morning. The stock market got halted yet again. Just crazy times we're living in. But if you are a buy and hold investor or you want to get into that, you really couldn't find a better time to jump in. So, have at it, guys. But thank you for watching. I will see you later. Peace out.